Good evening, everyone. This is Rajendran here, joining from Webinars. So, in today's session, what we are doing here is like a mini certification course on options trading. It's a long pending thing. We thought of doing something very interesting about the basics of options market. That too, with a reasonable ideas about market activity, like what we can expect via options trading. So before getting into the session, I hope the audio and video quality is good enough to kickstart. If yes, simply type yes. Just give me one more round of confirmation so that we can straight away kickstart with the session. All right, great. Thank you, Ankit, Jay Chandra, Ramu, and everybody. So without any further delay, we'll quickly kickstart with the session here. All right. Let me tell you what is the whole idea about this program is all about. The whole idea about this program is to give you the basic idea about options trading, particularly if you are beginner to options market, then it will be very much helpful to know about the nitty-gritties of the options trading and its parameters and its different types of options and how to use the option as a tool to control the risk. So that is the primary idea behind that. So without any further delay, let me move on. As usual, the session is getting recorded. The recorded video will be available, I think, hardly 1 or 2 hours from here. Once the session is over, after processing, it will be automatically available in the same platform, the very same platform. You can go and watch the recordings as well. A little bit about me. My name is Rajendran. I've been trading this market since 2006 onwards. I've been a telegram engineer from 2005 to 2014. It's been almost some 9 to 10 years of telecom career. In the meantime, I also learned trading, and now I'm a more of a full-time derivative trader. I primarily trade in Nifty and Bank Nifty options, and most of my trades are hedged trades. Right? I trade mostly directional approach. I mean, my approach is mostly directional. And I also train people on various topics. So far, I had trained 2,500 plus full-time and part-time traders on, particularly on options trading, volume, price analysis, market profile, order flow, and systematic trading. So we have our own approach towards looking into the volume and price actions. I'm also the co-founder of InfoLab, founder of Market Calls. I've been writing in Market Calls since 2007 onwards, since I started my investing and trading journey. And primarily, it is more of a trading journey. I've been penning down all my thoughts. What are the systems I had designed? I had kept open source in Market Calls, and I had written closely 3,500 plus articles about markets, trading softwares, automation, options trading, and a variety of wide array of topics like market profile, order flow, price action kind of stuff. I'm also the co-creator of the platform, automated trading platform called Algomojo. All right. So first, let's try to understand what is the options, right? So for the starters, options are nothing but contracts which are traded between option buyers and option sellers. So like, for example, we have different types of options, index options, stock options. Particularly when it comes to stock options, like for example, there are stock options like Reliance. We can, instead of buying stocks, we can trade Reliance options or Infosys stock. Instead of trading Infosys in the primary market and the secondary market, we can go and trade Infosys derivative product like futures and options. Now, why this options product exists? If you understand that, probably options are a tool to speculate in the markets, or we can also use options as a tool to hedge against volatility of the underlying stock. So it is generally used by the hedgers to protect from the risk of holding the stock in a bear market. You know, right, last couple of days, market has been going down, right? So these kind of phases, investors will suffer. Last 10 months, Nifty has been keep on crashing down. So these kind of scenarios, investors will be panicking, but some investors, they don't want to sell the stock in this downtrending market. They know that the downtrending is likely to happen. Maybe economic conditions are not looking good. So they want to protect from such kind of downfall. So they use options as a protective tool. And some people, they want to speculate on the options. Hey, market will move like this. A market will move down. A market Nifty will move 500 points from here. Or Reliance will shoot up another 5% in this series. So there are a lot of punters. They'll be coming and speculating in the markets. So both the communities do exist in the markets, right? So some people use options for speculation. Some people, they use options for protecting from the market shocks or market crashes. All right, let's jump in and then we'll try to understand more detail about the basics of options. First of all, let's try to understand the option buying part. We learned that in the past, like options are nothing but a contract which is initiated between the option buyer and option seller. In the market, it's very simple. Every buyer will be having an equal amount of seller. That is a given thing. That's a rule here. Even if I am buying a call option or a put option also, every option, if I'm buying, there is somebody is coming and trading against me, right? So when talking about option buying, how you can understand an option buying is like, assume that you are buying an villa. Let's say the villa is worth 1 crore. Generally, if I am buying any property, right, we will not pay the full cash in upfront. Generally, we'll be going with a concept called token money. So we'll be paying some premium, some 1 lakh rupees. We'll be paying, and then we'll be locking we'll be putting an agreement and saying like, this money, this house is mine. So we are locking the price, saying that, hey, I paid 1 lakh as a premium. This 1 lakh premium is like kind of a contract between the house buyer, which is me, and the opposite party, which is the house seller. So we agree to terms that I'm ready to buy. I have the right to buy the house at 1 lakh rupees. 1 crore rupees. Tomorrow, if the price of the house goes to 2 crore also within the next 3 months, because of some huge demand is there, I'm still have the right to buy the house at 1 crore because I'm locking the price at 1 lakh rupees. Something option buying also something very similar to that. If you're buying in the Reliance stock options or Infosys stock options, you have the right to buy the stock at that specific level. Right. So here the token money is what considered as a premium. Buyer pays the premium and seller receives the premium. So seller is whom here? The home seller. He receives the token money from us. The same thing happens in the option market also. In the option markets, option buyer pays the premium and option seller receives the premium. So this is with option buying. And then let's try to understand a little bit about option selling side. Okay. In the option selling side, the best example that we can quote is the insurance companies. Right, insurance companies, they make a ton of money from our insurance premium. We could have paid insurance premium in many forms, maybe a life insurance, bike insurance, car insurance, right? So what actually the insurance companies are betting that probably the accidents will not happen for your car. The accidents will not happen to you or to your bike. Even we have COVID insurance. 2020 COVID insurance was quite popular. So that is how they make money, right? They make a lot of money. Yes, accidents do happen. But what is the frequency of the accidents? It's very less. That is how the insurance players, they make money, right? They thrive. In fact, it's the very largest business in our country, like life insurance. LIC is there. National insurance is there. And a lot more players. There are Bajaj Allianz. And then now we have a lot more startups are jumping into insurance sector. In option selling, which is also very similar to insurance, what they're saying is like if something is going against option seller always bet against option buyer. That is the reason they receive the premium from them. If option buyer is bullish, then option seller think maybe it may not be bullish. Maybe it could be sideways. or it could be even bearish also. That is how the option seller's thinking will be. They'll be having a completely opposite view about the option buyer. If I am an option buyer, I'm thinking the markets are bearish. Then my opposite party is an option seller. He could think completely that whatever the option buyer thinking is wrong, and they totally come and trade against them. Okay, so option buyer and option seller, they combine together, the contract will be initiated. When it comes to option type, there are two major options are there, right? Only two options are there. In fact, call option and put option. But within the call option, a call option I can buy, I can sell a call option also. If I am selling an option, then I'll be considered as an option. I'll be called as an option writer and option seller. Anybody can buy a call option. Anybody can sell a call option also. Likewise, anybody can buy a put option and anybody can sell a put option as well. But there is a mild difference to that. Now, what is the difference here is, if I'm an option buyer, if I'm a call option buyer, it gives me the right to buy the stock. If at all the option price is moving in my direction fiercely, and it gives me the right to buy the stock. Likewise, for a put option, if I'm a put option buyer, it gives me the right to sell the stock. Okay. For an option seller, it is the exact opposite. Obligation to sell. They are always obligated. For example, think about the insurance companies. If some accidents do happen, as I said, the probability of accidents happening is very less, but accidents do happen, right? When that accidents are happening, they have the obligation to fulfill that. Yes, they had committed. For example, you're seeing, like in this case, there's an example here. Let's say Bajaj Finance, they are charging an premium, insurance premium of 4,699 rupees per year. So if something damage has been happened, let's say it's a car, then the premium would have covered a value up to 3.48 lakhs. So we can go and claim that money. Up to that money, we can go and claim from the insurance provider. Right. So what will happen if there is no accidents? This premium money, 4699, will go to zero. The value of the premium will be worthless by end of the year if there is no accidents do happen. And the premium will be owned by the insurance provider. That's exactly the same thing happens in the markets, right? So options, they do trade in the form of premiums. Option buyer's profit is option seller's loss, and option seller's profit is option buyer's loss. So if I want to have a bullish view in the markets as an option buyer, probably I have to buy a call option. And if I'm thinking market will go down, market will be bearish, then I have to consider taking a put option. So we know that option buyer always pay the premium, right? So that is what we call as a debit. Most of the option buying strategies are called as a debit strategies, because the money will be debited from the option buyer account. Whereas option seller, they receives the credit. Okay, they receive the credit from the seller and has the obligation to sell the underlying asset. Now let's take some reality. I'll try to give some pictorial representation how this happens. Okay, let us say I'm buying an option contract. I'll go and buy an option contract. Let's say maybe I'll go and show you. Let's say this is 15,300 option contract. Probably you could have seen it in your broker's terminal. These days, brokers they do provide that charts where you can go and see those particular contract. Right. So since it's a contract, it always have an expiry date. So you'll be seeing an expiry date over here, and most of the option premium erodes in time. You know that I can also see it in a 5-minute chart, 1-minute chart, 3-minute charts. Right. Let's say I'll put it in something like a 15-minute time frame charts. So this is the option premium which happened last couple of days. The call option has been keep on going down because markets are bearish. If the markets are bullish, what will happen is like put options will go up. Let me pull up the put options over here. I'll take Nifty 15,300 put option. P means put option, C means call option. Let me take the put options over here. So here is the put options. You can see that last couple of days, Nifty has been going up. So where I can see Nifty, let me pull up Nifty here. Nifty index. I'll go to index, Nifty 50. So Nifty is one of the top traded option instruments. So last couple of days, what is happening? Nifty has been keep on. I'll go to Nifty. So here is Nifty. You know, right, last couple of days, what is happening? The price of Nifty has been keep on coming down. Right? The Nifty index itself coming down. Almost there is a downfall of more than 1,000+ points within the last 7 trading sessions. So what will happen is like if the price is going down, put options will tend to make money. So here you can see that the put options are increasing, it's in premium. So whatever the price that we call is like, we call it as a premium. Whereas the call options are totally eroding in time. Call options are eroding in time because it's not working in the favor of call option. Call option can call buyers are losing money here. So if the call option is moving down, what does it mean? If the call option is moving down, that means call buyers are losing. Call buyers are losing money, and call sellers are making money. Because the loss of call buyers are nothing but the gain of the call sellers. And likewise, if I look into the put options, who is making money here? The put options. Put options are rising in price. So put options has been last couple of days been rising in price overall. So put buyers are making money here. Put buyers are making money here. Making money. And put sellers are losing money here. Losing money. All right. So let's try to understand if I am buying put options. I'll simply go and buy, and then I'll set the order type and I'll try to buy it. Okay. And I'll place the order. If I'm an option seller, what I'll do, I'll go and sell the option and I'll place the option sellers. Now there is a difference between that. Between an option buyer and option seller, there is a major difference between is there. See, actually, we learned that option sellers are what? Insurance providers, right? So when I say option sellers are insurance providers, they are the one who's taking the ultimate risk. Option sellers are the insurance providers, right? Are they insurance providers? So they take the risk. They charge small premiums, and in case of accidents, they have to pay heavy sometimes, not every time. When it comes to the market also, the option sellers take the risk. So option sellers always have unlimited risk. Critically, not practically. The unlimited risk is only in few occasions. Like when there is a major crisis, is like COVID crisis is there, or demonetization, or there are any political events like Brexit kind of things are happening. Or some sort of an trade war tension which was there back in 2018 kind of timings, and we have something like an North Korean missile tension. When there's kind of some sort of tensions are going on, or some sort of scam is going on. Sometime back there was a Satyam scam was there back in 2008. Satyam scam, or some sort of a crisis is going on. Back in 2008, we also have subprime crisis. And then back in 2015-16, we have NPA crisis, a Nirav Modi scam. Nirav Modi scam. We have 2G scam in 2008. Now, these kind of things, if suddenly markets are suddenly dropping down, so then, or if suddenly markets are shooting up also, option sellers will be at a biggest disadvantage. So they take the risk, so they decide the premium. So option sellers take the huge risk, and so they decide the premium. They decide the premium. For example, think about an insurance provider itself. Imagine an insurance provider. So he is providing a life insurance to a 20-year-old. What is the chance that the 20-year-old may be about to die? It's very less, right? So probably they'll be charging less premium for him. He'll be paying lesser premium for him. Lesser premium. Whereas if the insurance provider, let's say, if they are selling insurance to then maybe an 80-year-old person, what are the chances that he could die? Probably that's very higher compared to the 20-year-old. 80-year-old have a very high chance of nearing the death. So he might be charged an higher premium. Okay, so likewise, the same thing is applicable in the markets also. If the markets are calm and steady, if the markets are calm, means not much of a huge fluctuations in the markets, not much of tensions, no tensions, right? So a reasonable movement in the markets, slow and steady movements, then option sellers will demand less premium. But think about that, if markets are going in some form of crisis, if the markets are in crisis, right now we are in crisis, right? So we are like, there are crises like US inflation rate is going up, and so interest rate is also going up. And that free money, what US printed free money, that printer has been stopped. Printer got stopped. So worldwide, all the inflow into the equity market has been stopped. So markets are struggling to go up, and the price started crashing down. Right. So these kind of places, we are in some sort of a crisis, some sort of a liquidity crisis, we can say like that. So they're also called as a global liquidity crunch. Like across the global markets, new money is not flowing into the markets. New investors are not coming and putting money in the stocks. Earlier, they blindly throwed money on new age tech companies like Paytm, Zomato, Nykaa. What are the companies coming in? They're coming and invested. Any IPO coming in, they invested blindly. But that is not happening right now. People are very choosy. People are very conservative. And because we are in crisis, so new money is not coming in. So tensions in the market increases. People started selling. Markets are dropping crazily on a daily basis, right? Of course, not on a daily basis, but some of the days it's crashing heavily. So investors are under panic. So this creates panic among investors. What does that mean? That means option sellers, they will start charging higher premium, because option sellers are the one, they know that they are going to take some risk. Maybe the tomorrow market can crash even more crazily. So whether they like it or not, they have to sell the options, right? That is what the insurance providers do, right? Even in the time like COVID crisis, they know that large amount of death can happen. Did the insurance provider said like, no, I will not do my business? Of course, they had done the business. The same thing happens with option sellers also. Whether they like it or not, they have to do the business. But option seller here, they will demand huge premium. Not only whenever there's a panic, whenever there's a greed is there. For example, election results. For example, whenever there is an Indian election results are there, Indian election results are there, you could have seen that there'll be a huge fluctuation will be there in the markets. Greed will be running among every other traders. There'll be a huge amount of greed. So huge amount of greed. So that will result in huge expectations. When there are huge expectations are there, again, option sellers demand more premium. From whom? From the option buyers. Okay. So this is a basic concept behind option selling and option buying. Okay. Let's go even more in detail about that. So we know that call option or put option buyers, they pay the premium, and option sellers, it could be a call option seller or a put option seller, they will be receiving the premium. Now, how this transaction happens in real time? So let's say we'll go and take a particular call option. So call option will be having in the form of strikes, right? So if you're looking into the any particular options, it always have an expiry date. It'll be having a strike price and lot size in 50 shares, like the number of lot sizes like 50 shares for Nifty and 25 for Bank Nifty, and each and every stock has its own lot size. So let's try to understand some basic things about it, right? So maybe we can go and I can go and pull you the option chain. First of all, I'll go to the NSE India portal. NSE India portal. Now, from the NSE India portal, you can always go and reach Nifty, type Nifty in the symbol box. From here, you can go to equity derivatives and then scroll down to option chain. So we'll be having a complete set of table over here. Maybe if you are an option, first time if you are looking into options, you'll be getting mesmerized. But otherwise, if you are a very new to option trading, maybe you may get wonder what all these things are all about. It's nothing much. It's all about price movements and then how much volume happened. What is happening in the options market in a very nutshell. Okay. So we have at the center point, we have something called strike price. So we have different strike price, right? So different strike price we are having it. So what makes the option buyer is like the option buyer can speculate on different options. So right now, what is the last traded price? The last traded price of Nifty, I can see it over here. So the Nifty is the Nifty spot price, 15,293. Now, as an option buyer, I can speculate maybe option Nifty can go to 15,300. I can bet on maybe Nifty will go above 15,300 or Nifty might go above or beyond 15,400 in this expiry. Right? If I am too bullish about the markets, I can even bet on Nifty will go to 15,600 in this particular week. Why? Because the contract, whatever I'm having is the 23rd June contract. Likewise, we have multiple contracts. Even we have far away contract, 1 year contract, 2 years contract. That is what we call as a leap options. Those are long-term contracts. But most of the traders, they prefer to trade short-term contracts. Yes, some big traders, they also love to trade long-term contracts also. Okay, so we have different types of contracts. Particularly, the most popular contracts are weekly contracts and monthly contracts among the traders. The first-timers who are beginners in the markets, they love to trade the monthly contracts and weekly contracts most of the times. So as of now, I'll keep the monthly contract. Here is the 30th June. So 30th June contract, if I go to the option chain, I'll go very near to the strike price of 15,293, right? So 15,293. That means 15,300 is the nearest strike price. What we can see here is, as the strike price is increasing, so even though I'm putting a down arrow, the value is actually increasing. Okay. The premium The left-hand side, what we are having is the call option premium. You can see that the call option premium is reducing in value. Why? Because if the Nifty value is increasing, then we know that naturally call option value also increase. But across the strike price, you could see that the values are decreasing. What does it mean is like, what is the chances of, or we can say like, I better give some better example. Maybe let's say we'll take a cricket as an example here. We'll take a cricket as an example, okay? Cricket. You know Virat Kohli, our Indian team captain. Of course, he's not the Indian team captain in T20. Probably he's not there in the match also. Let's say a particular match, Virat Kohli is coming and batting, and people are betting. Some people are betting that he will hit at least a minimum of 25 runs. And some people, they bet 50 runs, that he will bet 50 runs. The betters here is like, if you bet, let's say if you bet 100 rupees, if Virat Kohli hits 25 runs, maybe you will be getting some 110 rupees. That means you will be getting 10 rupees profit. 100 rupees is yours and 10 rupees your profit. 10 rupees is going to be your profit. And you know that the chances of hitting 25 runs is very easier. So the payoff is also very less. The 10 rupees here we can consider as a payoff. So maybe what is the chance of hitting 50 runs? Comparatively lesser, right? Comparatively lesser than 25 runs. So here the premium, maybe you can bet 100 rupees. 100 rupees is your the money that you are betting. In all the cases, bet is always going to be 100 rupees only. Maybe if you bet 100 rupees, you will get 110. Whereas here, if you bet maybe rupees 50 rupees, okay, you will get that probably we can say like 10 rupees. So if he's going to bet 10 rupees, so that means what? 50 rupees, you will get total 60 rupees over here. 60 rupees your final money, whereas 50 is yours and that 10 rupees is your profit. So here we have 50 rupees betting, I'm able to make 10 rupees over here if Virat Kohli is going to hit 50 runs. The 50 rupees is the premium over here. You will be paying very little money as a bet, but the probability is slightly higher. So reward is also very higher. That means here the profit is like 10% of the profit, 10% of invested money, 10% of investment. Whereas here, it is you get the 20% of return, 20% returns. Here the returns is how much? 10% returns. 10% returns. What is the chance that if I'm going to bet rupees 25 and I'm going to bet saying like Virat Kohli will hit 100 runs. So if he's going to hit 100 runs, maybe, you know that it's hitting a century is not a easiest thing. It's going to be an slightly a difficult one. So obviously the payoff is also going to be very high. So if 25 rupees you're going to bet, you will get 25 rupees. That means you will end up getting 50 rupees. 25 rupees is yours, and another 25 rupees is going to be your profit. So that means your returns are going to be 100% returns. Probably something like, think about something unimaginable. It's not unimaginable, but it's very, very highly unlikely in most of the scenarios where you're going to bet only 1 rupee and you are expecting Virat Kohli to hit 100 runs, right? So the payoff is going to be like something like very crazy. The payoff is going to be crazy over here. So it's going to be like maybe you're going to get some 20 or maybe even 100 rupees. 100 rupees is going to be maybe 101, we can say, where 1 rupee is your investment plus another 100 rupees is going to be your profit. What kind of returns it is? Like almost 1000% returns, right? 1 rupee invest and then you get 100 rupees. If you are going to win, you know, right? The chances of one winning on betting 100 rupees, 100 runs that Virat Kohli is going to hit is very, very less. So if the probability is less, you have to pay a lesser premium and your payoff will be very high. You will be right if you are right. Okay. So let me put it in a nutshell. So this is the same thing which applies to the options also, call options also, and put options also. If the probability of success, if the probability of happening or whatever you're expecting, let's say if I'm a call option, I'm expecting a bullish view. I'm expecting markets to go up. If the probability of happening is very high, then what will happen? High premium will be demanded. High premium will be demanded. Demanded by whom? Demanded by the option seller. Option seller will demand high premium. Option sellers. For example, here Virat Kohli hitting 25 runs, it's casually it's going to happen. So they will charge a high premium. If you win, you will get less payoff. So if the option buyers are right in their view, they get lesser payoff. Lesser payoff. If the option buyers lose, they lose everything. If the option buyers lose, they lose most of the money. But if the probability of happening is very, very less, option sellers are not taking much of a risk. If the probability of happening is very less, then lesser premium will be demanded by the option sellers. You know that Virat Kohli will not hit 200 this time. The chances are only 3% chance that he might hit 200. So option sellers, they go and bet against the option buyers and they happily accept those things. But if the option sellers are wrong and option buyers are going to be right in their view, they got a huge payoff. For example, last expiry, 15,700 put option. It was like trading at 10 rupees. The 10 rupees ended like end of the day, I think somewhere around 400 rupees or 350 rupees it ended. Like a huge money was there because market crashed almost from the day high. Nifty crashed 500 points intraday. So those kind of places, the option buyers, if they're going to write in their view, they get a huge payoff, and option sellers are obliged to pay it. No matter what, they have to pay that money. Else, option sellers, if option buyers lose, they lose all their money. They lose all the premium paid. Okay, that is what it happens. Exactly the same thing happens with options also. Let me go to the option chain here. This is our recent option chain of monthly contract. Okay. So each and every contract will always have an expiry date. So if I see that the call options, if the price moves higher, so I'm putting a down arrow, but the price is moving higher. As the strike price is moving higher, you can see that the premiums are charged lesser and lesser and lesser. Here, 15,300. The chances of 15,300 is highly possible because 15,300 is trading very close to the Nifty spot price. Nifty spot price is 15,293. So a huge premium is there. And so the reward is also very, very lesser, but a reasonable reward will be there. Your chances of winning is very high. If you're going to buy 15,300, your chances of winning is very high, but the probability will decline if you're going towards 15,400, 15,500. For example, think about you buying 15,800 contract. What is the chances of Nifty hitting 15,800 compared to 15,300? It's very, very less. That's why lesser premium is charged on the call option. Likewise, on the put option also, put option is exact opposite to that. If you are looking into the premium, so here is the put premium. This row talks about the put premium. As Nifty is going down, more and more down, if you are betting on 15,300, the chances of Nifty going down below 15,300 is very high, and so very high premium would have been charged. Right? As Nifty started keep going, let's say you betting on Nifty 15,000 levels, the chances are very, very lesser compared to 15,300. So here we are expecting Nifty to go down below 15,000 levels, right? So the premium collected is also very, very less. The premium charged by the option seller also very, very lesser, because option sellers are taking less risk, so they demand lesser premium. Here at 15,300, option sellers are taking more risk, so they demand high premium. Are you clear with this? Whatever we had spoken so far, if you are clear, please type clear. Yeah, of course, that is 10,000%. I'm sorry. Yeah. All right. Zamir Patel says clear. Madhu says clear. Arun Bola, Malay, Pradeep, Lakshman, Vinod, Ankit Raj, and everybody says clear. All right, great. And thank you, everyone. So, based on it's you could understand by now that option trading is more to do with probability. So, as an option trader, you need to have not only directional thinking, but also probabilistic thinking. It doesn't matter whether you're an option buyer or an option seller. You need to have a probabilistic thinking. Then only the chances of survival in option markets is very, very high. Only if you are having a probabilistic thinking. If you are not having a probabilistic thinking, blindly coming and trading options is dangerous. Just like that, one can make a very big money also. Just like that, they can lose all their money also if they don't have a probabilistic thinking. You know, right? Gamblers, generally, they don't have a probabilistic thinking. Randomly, they will come and trade. If you want to gamble, yes, one can easily gamble in option very easily, but they can play some lottery tickets. But if you don't have any solid idea about probability, particularly in options trading, then it's going to be difficult in the long term to survive or to make options trading as a career. All right. Anyways, let's move on. We know that monthly contracts are initiated between the option buyer and option seller. Generally, monthly contract expires on the last Thursday of the month. And weekly contract expires every week, Thursday. Thursday is what, when it comes to Indian stock markets, Thursday is the expiry. Of course, some contracts in BSE, it expires on Tuesdays, right? And some other contracts also have different expiry dates. For example, USDINR options, currency options, they have expiry date on Fridays. So different exchanges might have different expiry dates. When it comes to NSE India, Nifty, Bank Nifty, stock options and trading in NSE, expiry is always on Thursdays. All right. And you know that Nifty and Bank Nifty is one of the top traded contracts in NSE. And let's try to understand the moneyness of the options. Now you might be wondering how the premiums are decided. How do we know that how the premium pricing is decided? By whom? Who decides the premium pricing? Or how the price of the premium is decided? Why? How based upon Nifty price movement alone is it decided, or something else? Now, first, even before to understand that, we need to understand the concept called moneyness of the option. An option can be considered as like at the money option, out of the money option, in the money option. These are different types of option contracts, right? So each and every option, right, it has its own intrinsic value. See, for example, let's say Reliance. The value of Reliance is like a kind of some billion, right? So some X $billion, we know that. And likewise, we know that Bitcoin has its own value. Like the market cap of Bitcoin was sometime back a little bit above trillion, but now it went down below the value. It's now the market cap of the entire Bitcoin universe itself less than 1 trillion. So it has its some value. Likewise, every option has its own value. That is what we call as an intrinsic value. Particularly, we categorize based on the intrinsic value, we categorize them as at the money option, out of the money option, and in the money options. Only in the money options will have intrinsic value. For example, maybe I'll try to first explain what is at the money options and out of money options and in the money options. At the money options are the strike price nearest to the expiry. For example, I'll try to pull up the NS India portal itself. So you can see that the shades of yellow and shades of white, the shade ends over here. This is where the shade ends exactly. The shade ends over here. 15,300 is where the shade is starting up. The 15,300 is the one which is trading near to the spot price. We know the spot price as on last Friday is 15,293 something, right? That's the spot price of Nifty, or we call it as underlying. 15,300 is trading very closer to that. That is what we call as a at the money. So at the money call option also 15,300. At the money put option also 15,300. We call it as a at the money. If I go far away on the downside in the call option, so this is call option side, this is call side, and here we have the put side. This is put option side. The one on the left hand side is call option, and the one which is on the right hand side is the put option. So if I go down, so we know that the center point is what? At the money, and the one which is, if the strike price is going down on the call side, is the out of the money call option. Out of the money OTM call option, C. And you can see that as the strike price is increasing, the premium will also keep on reducing. We know that premium reduces because the chances of happening is very lesser. Whereas on the call option side, it goes down. Whereas on the put option side, it goes up. Right? That means the strike price, reducing strike price, the premiums, lesser premiums will be charged. All right. So in the money options are something like, for the call options, if the Nifty strike price is reducing, more premium will be charged, and those premiums, the shaded yellow color zones, are nothing but in the money options, because ITM, are in the money call options. And likewise, the shaded ones on the put options are nothing but the in the money put options. Out of the money options are always cheaper options. Will be having no intrinsic value. It has only time value only. Whereas in the money options, it has intrinsic value. Not only intrinsic value, but also have some little time value also. So in a nutshell, I try to explain in a nutshell what is what. Let me go back to the drawing board. So we have at the money options, right? At the money options. What is at the money options? Options trading near to the spot price. Spot price, or we call it as an stock price, underlying stock price. Those options will not have any intrinsic value. There is no intrinsic value. Whatever the premium is there at the money, it is only time value. Only time value. The time value will be very high at the money options. Time values will be very high. High premium will be there. And everything is time value only. Whereas for out of the money options also, will have lesser premium. We know that premium is lesser premium. Here also we have only time value. Only time value. We have less time value always. And this value, this time value, is the one which keeps on eroding on a daily basis. Not only on a daily basis, every second the time value erodes. And this time value is determined by a mathematical formula. So in Indian market, we use Black-Scholes formula. So it's a kind of a mathematical formula, quite slightly complex mathematical formula with some slightly higher order mathematics. So that, based upon that, the option premium is designed in such a way like it should lose its value on a daily basis, and this time value goes to 0 on expiry. So this time value goes to 0 on expiry. That means what? On expiry, at the money options and out of the money options will have 0 time value. Maybe in another terms, we can say like the premium will go to 0. That means that is the premium of at the money options and out of money options will go to 0. Go to 0. Or we can say like will expire worthless. It doesn't have any value at all. Expire worthless. Now all these money goes to whom? If the option goes to 0, who gets benefit out of it? Option sellers, right? Yes, absolutely. Option sellers, they get the benefit out of it mostly. Right. All right, let's go back a little. So we learned that at the money options and out of the money options will not have any time value. But how about in the money options? How to calculate the intrinsic value of the in the money options? Let me give an example how the expiry will be settled. First, you need to know how the expiry will be settled on expiry. Let's say right now Nifty, let's take a simple example. Last traded price is 15,300. I'm just taking a rough example so that the calculations will be a bit easier. Okay. Let's say one of the option, we'll take an in the money option. Right now, 15,200 call option is in the money option. In the money option. In the money option will be calculated from the strike price. So last traded price is 15,300. So at the money option is 15,300. 15,300. 15,200 call option is, you can say like 100 points in the money. 100 points in the money. That means the value of the option itself worth 100. So on expiry, let's say 15,200 call option will have 100 rupees. 100 rupees if Nifty expires at 15,300 itself. It's very simple. The calculation is very simple. On the expiry also, the Nifty in the money option has to close as in the money. In that case, the spot price minus strike price, which is nothing but 15,300 minus 15,200. That is nothing but the 100 rupees. Exactly the settlement happens on the expiry date at 100 rupees. So maybe if on the expiry date, same 15,300, 15,200 call option, it doesn't matter whatever the expiry premium right now it is. On the expiry, let's say if Nifty goes to 15,400, then the intrinsic value will be how much? Intrinsic value is likely to be the same thing, right? It's going to be 15,400 minus 15,200. 15,200 is the spot price. 15,400 is the spot price, and 15,200 is what? 15,200 is going to be the strike price. So on the expiry, the premium settlement will be at 200 rupees. Let me take the live example itself. Let's say right now, I'll go to the 15,200 call option. This is which contract? I think this is a monthly contract, right? This is a 30th June contract. See that I selected 30th June contract. I'm getting an option chain table. From the table, if I go to 15,200 call option, the yellow shaded one, which is in the money, right now the premium is 347 rupees. Right now the premium is 347 rupees. Whereas the Nifty is getting traded, assume that 15,300. That means right now the intrinsic value is 100. 100 is the intrinsic value currently. That means the 15,200 is 100 strike in the money. And 15,100 is 200 strike in the money. So this 200 strike in the money is calculated based upon the current spot value. So 15,100 is 200 points in the money, whereas 15,200 is 100 points in the money. So that is what we call as an intrinsic. That is the intrinsic value. Intrinsic value. 100 points is the intrinsic value for the 15,200 right now. It keeps on changing based upon if the spot price changes. The intrinsic value of the stock also or of the index also keep on changing. Intrinsic value. Right. So we know that 347 is the total value of the premium. 347 is the total value of the premium. Among that, 100 rupees is the intrinsic value, and rest 247. We know the 100 is what? Intrinsic value. Intrinsic value. How about the remaining 247? The remaining 247 is what we call as a time value. Time value. Remember one thing, intrinsic value will not erode in time, whereas the time value will definitely erode in time. Okay, no matter what, the time value will always erode over a period of time. And also remember one thing, right now, let's take the same example, 15,200 itself. Okay, so let me take a screenshot of this, 15,200. So that will be a bit helpful for us. Let me go back to the whiteboard. So I'll paste it over here. So that will be helpful for us. So imagine that the last traded price is how much? Last traded price is 15,300. It's the last traded price. So assume that if Nifty is at 15,300, if Nifty is at 15,300, then the intrinsic value of 15,200 will be 100 points. But if the Nifty value increases, let's say Nifty value goes from 300 to 305, then the intrinsic value of 15,200 call option will also increase its intrinsic value. The intrinsic value increases. Right, so intrinsic values depend upon the spot price itself. All right, whereas the time value, no matter what, over a period of time, it will be keep on eroding in time. All right, let's get back into the topic. So now we learned what is at the money options, out of the money options, and in the money options. Likewise, for put options, in the money options formula is very simple. For call options, if you want to calculate, for call options, to calculate the intrinsic value, call options, you have to put spot price minus the strike price. Whereas for put options, it's exactly the opposite. The calculation is a bit different. It's strike price minus the spot price. Only for in the money options. So we calculate only for in the money call options and in the money put options. All right. So let's go a little forward. So basically, if somebody is a call option buyer, The expectation is what? If I am buying, let's say Nifty is at 15,300. If I am buying 15,500 call option, I generally expect Nifty to go beyond 15,500 on the expiry basis. On the expiry, at least I will expect Nifty to go beyond 15,500, at least above 15,500. I'm having a crazy expectation. Maybe if I'm buying 16,000 call option, that means I'm expecting Nifty to go by 700 points in the same expiry. So that means I'm super bullish. So depends upon what kind of trader you are. You can have a mild bullish opinion, or you can have a highly bullish opinion, or you can even take a super bullish opinion also. Depends upon the probability you'll be rewarded. That is how the call buying works. For a call seller, exactly the opposite view of the call buyer. So if call buyer is expecting bullish, then call seller here, 15,500 call seller, he's expecting Nifty spot to go down or at least trading below 15,500 is his expectation. Here, call buyer, maximum what he can lose is the premium money. He has a limited risk, but unlimited profit. Tomorrow, suddenly Nifty goes to 17,000 from here, then call buyer will be at a very big advantage. Whereas call seller, if Nifty is anywhere going to expire at the money or in the money, I mean expire at the money or out of the money, then the option will go to zero. So call seller take all the premiums. Call seller always have a limited reward but unlimited risk. You know that whenever that accident is striking. For a call seller, accident is nothing but what? Market totally moving in a strong uptrending action. Whereas exact opposite things for put options. For a put buyer, if market goes down, like let's say for example 15,300 is the Nifty spot price. If somebody is buying an 15,000 put option, that means the put buyer is expecting Nifty to go down below 15,000 or even more than that. If suddenly market is crashing heavily, let's say tomorrow, Monday, there's a 10% crash, then the put buyer will be minting a huge amount of money there. So the put buyer will be paying a limited risk. The premium is the maximum risk he is taking, but market can reward him unlimited way if only the markets are hugely crashing. You know, right? On a daily basis, market will not just like that crash hugely, or the market will not go up hugely on a daily basis. So the chances of occurring such kind of extreme moves are very, very rare. Only in case of extreme movements, the put buyer or the call buyer will make money, huge money. Of course, there's a reasonable amount of money is there on the markets. So means even for call buyer also or put buyer also, practically there is a limited risk and limited reward. I'll tell you, theoretically, maybe it could be limited risk and unlimited profit for an option sell buyer, but practically, so let's say first we'll try to understand what is theoretically. Theoretically, option buyer, right? So theoretically, option buyer has limited risk, unlimited profit. But practically speaking, there is no unlimited profit all the time. So practically, most of the times, option buyer will have what? Option buyers will have limited profit and limited risk most of the time, practically speaking. And that is true with the option seller also. Option seller also, theoretically, it says, theoretically, so in theory, option seller has unlimited risks, but limited profit only, limited profit, small profits, that's what we speak. But when practically, most of the times, option buyer, our option seller are in advantage. Why they are in advantage? Because option premium erodes in time. So time is the biggest friend for the option seller. Whereas for an option buyer, time is going to be a biggest enemy because option premium is designed to lose on a daily basis. The time value erodes slowly in time. So practically, even for option seller also, it's going to be limited profit and limited risk. Risk is going to be limited because market doesn't crashes on a daily basis. Market doesn't goes up 5%, 10% on a daily basis. Only few places, as I said, accidents do happen. So both are having a same stuff, but still option seller has the most advantage over here because option premium works in the favor of option sellers, whereas for option buyer, time erodes. So time premium erodes in time. So premium erodes in time, and so option sellers have more advantage compared to the option buyers. So probability for option buyers will be lesser compared to the option sellers most of the time. That's why most of the time option seller wins in the long run, and option buyers, they make huge money when such kind of accidents do happen. So equally likely there are risk and reward is there on both the sides. So some people take sides. Like for example, some people they always they want to use only Google search engine, or they always want to use Samsung smartphones or Apple smartphones. They don't change it. Likewise, here also we have sides in the industry. Some people they want to do only option buying, and some people they only want to do option selling. So think about a sportsman, right? So a very good sportsman, right? He shows variation in his trades. In his sportsmanship. Any game if you take, let it be cricket, let it be badminton, let it be tennis, let it be football, let it be hockey. A very good sportsman always shows variation all the time. Even a very good sportsman, even though he has his own signature moves, of course, every batsman, every bowler, or every tennis player or a football player, they have their own signature traits, but they don't keep on playing the signature traits over and over and again. Now, what I want to say here is like in trading also, at times we have to practice option buying. At times we have to practice option selling, kind of in a hedged mode, in a very less risky environment. That is how an good trading is all about. A good trading is all about showing variations, because every day markets are not going to move every day the same way. Yesterday's market is going to be different. Today's market is going to be different. And probably Monday's market is going to be different. Next month, the market is going to be different. Of course, in this entire last 5 months, you could have been seen n number of times, like Russian-Ukraine war tension was there. That time market was different. When Fed rate announcement was coming in, the market reacting completely different. Or when some good news are happening in the markets are reacting differently. So different time markets will do different. So we traders also have to learn to do variation in our trades. Sometimes we have to be conservatively bullish. So for example, as an option trader, how I do take a trade is like I do take a trades based upon how much conviction I'm having. If I am having high conviction in my trades, high conviction, I will go with in the money options. Or if I'm having low conviction, probably I'll try to take my positions on the option seller side. I'll try to deal with an option selling side. Option seller. I'll become an option seller, probably with a hedged instrument. I always have limited risk, limited reward. Even with in the money options also, it's a limited risk, limited reward. But it's a decent money will be out there. If you're right in your view, unlimited profits are guaranteed. If you're having a high conviction in the markets, then you will get the unlimited reward. As an option buyer, you will get unlimited reward. reward if you are right. If you're having a high conviction and you're right. If you're having a low conviction, but still you are turned to be right, well, you know that option seller have a high probability of success. If you are expecting some trend to happen, but if you are not sure about it, but still you want the winning probability in your favor statistically, so we go with an option selling in a hedged mode, but still we trade directions. There we have limited reward. We get small reward for what we being right in our studies. So why I'm explaining about this high conviction and low conviction is this is not possible with stocks. Yeah, maybe if you're having high conviction, you can go and bet huge money. Or if you're having low conviction, you'll be betting small money. That is possible in stocks. But when it comes to options, we deal it in a different way. If I am having a high conviction, I'll go and trade in the money options. Or if I'm having low conviction, I will be where the probability of success is very, very higher that way. And if I am having a low conviction, still my probability of winning is very high because I'm an option seller. So that's what the variation I'm talking about here. So depends upon what I am thinking in the markets. Depends upon that, we can change our plan. So depends upon that, we can select our strike price. Well, let's take a small example here. Right, so let's go and try to take a simple call options. Okay, so imagine that I'm having an Reliance stock. Imagine Reliance stock is currently trading around 2,500 rupees. Assume that 2,500 is the current spot price or the underlying stock price. We know that the lot size of Reliance is 250 shares. And if I'm having a bullish view, then on the expiry day, we can put a table saying like, what if Reliance expired at 2,400? If Reliance expires at 2,400, you know that, right? What will happen? If the expiry is 2,400 and the strike price, what I'm choosing is like, let's say 2,500 call option itself. So then 2,400 option will become out of the money option. It becomes OTM options. It becomes what? Out of money options. Out of money options. Well, maybe we'll do one thing. We'll try to take some practical examples. I thought I mostly believe in practical examples rather than some textbook style example. So I'm going to go to a tool called Opstra. Opstra is a tool where you can go and freely use the tool. They also have a paid platform as well, but most of the basic things as a beginner, you can use this tool as free of cost. So I'm going to use Opstra. I'll go to options. From there, I'm going to go to strategy builder. Let's say right now Nifty spot is like 15,293, or maybe I'll go and pull up Reliance. We'll try something other than Nifty. Let's say Reliance. Reliance right now the spot price is 2,605. If I am bullish in Reliance, let's say if I go to options, I go to 30th June contract, which means the contract is about to expire in another 13 days or so. I'll go and select 2,600 call option, which is at the money call option. Okay, I'm going to add the money call option. Right now, the premium is how much? 57 rupees. What is the lot size? Lot size is 250. Here I can see the 250 lot size. Option premium is 57. That means I have to pay how much? I have to pay 57 rupees, 57.65 into 250 rupees. It's a premium I have to pay. The premium I have to pay to the exchange. I mean, pay to the seller. I have to pay. So how much that comes to? Let me go and add the strategy here. So I'm having a bullish view in the Reliance. Not so bullish, but moderately mild bullishness. I'm expecting Reliance to go to something like 2,700 or 2,800. That's a kind of some mild bullishness. It's a mild bullish view I'm having. I'm having another 12 more days to expire. So as we are having more time, we'll be having more premium. we have less time, we will be having lesser premium also. That's another important thing to notice here in case of options. So let's try to understand here. So here is the payoff graph. You could see that the payoff graph is always plotted for the expiry date only by default. Of course, you can change. Maybe you can go and change the date here. The payoff date, the payoff graph is plotted for the expiry date. I can go and say like maybe I want to put the payoff graph for Monday. I can go and get the payoff graph for Monday. Automatically, the tool will plot the payoff graph for Monday session. It's a bit slow today. Maybe I don't think I'll try one more time. I think a bit slow here. Reliance. Yeah, I'll take Reliance. I select options. I'm gonna buy the options, one lot, and I'm gonna say like 2,600 call option. What is the premium? 57.65 is the premium. I'll add it. So now on the expiry date, let's say we'll put a table over here. We'll try to understand. Let's say on the expiry date, what is the maximum money I can lose? The maximum money I can lose is how much? The entire premium, which is nothing but 250 into 57.65, which is nothing but the maximum premium I can lose is 14,000 rupees I can lose. So that is what you can see in the payoff graph. The payoff graph, what it says, like if anywhere Nifty is gonna go down below your down below the spot price, maximum money that I can lose is, even if tomorrow Nifty is gonna crash by 20% also, I'm gonna lose that only the premium money, 14,412 rupees. Right. But if the price is gonna move in my favor, particularly a huge move if it is gonna happen, then unlimited reward is guaranteed. This is where we get an unlimited reward. The payoff graph is showing so unlimited reward. Okay, whereas the payoff graph is showing like it's having a limited risk. The limited risk is what? Maximum loss I can make is what? The entire premium money I can lose. That is why the maximum loss is, if you are investing 14,400 in that particular trade, you could lose your entire capital. I mean, entire money that you can lose on that particular trade. But remember, this payoff graph is plotted for the expiry date. It is not expiry date. But in reality, not every trader will carry the trade till expiry. Option buyer, since they have to be right in their direction. Some option buyer, what they will do, they will buy right now. If price, even a small increase in Reliance price, premium could increase. So suddenly they could sell it also. If I'm buying at 57 rupees, it goes to 59, I can immediately sell also. There's no obligation that I have to hold till the expiry. But if you are holding till expiry, you are allowing the position to expire, then it will settle only if it is becoming in the money. Then you will have premiums only if it's going to be in the money. That means anywhere above 2,600 only, there will be some premium will be available. So you notice a term called break even. If Reliance is reaching 2658, 2658 rupees only on the particular date, on the expiry date, if Reliance is going to reach 2658, then what will happen? Expiry will have only in the money, right? So Reliance, if it expires, means if the spot on expiry is at 2658, then your 2,600 call option will have only intrinsic value, right? Only 58 rupees is the intrinsic value. So what is my buying price? My buying price will be like roughly around 58. And on expiry, the premium will be staying at 58. If I want to sell it, I have to sell it at 58 only. So obviously no profit, no gain over there. So if you're option buyer or even if you're option seller also, you need to know where is the break even is. The break even for option buyer will be always at the higher level, slightly higher level. Even though you are buying 2,600 call option, by expiry, only if it goes above 2,658, then only your positions are profitable. You can see that the break-even point is something from where the strategy started making money, the green line where it started occurring. So actually, this is a zone, which is a break-even zone. So only from the break-even zone, the profitability starts. That break-even point, this point over here, which is nothing but 2,658. Okay, you can also keep your cursor and you can check it out. What is the break-even point? And that is the same thing the table also shows. Right. So the maximum profit is unlimited. Why? Because if the price keeps on going up, the strategy will have unlimited profit. But we know that that cannot keep happening. What are the chances that Reliance in this series itself we can go to 31.25? Very, very rare, right? It is like Virat Kohli hitting some 500 runs in the same T20 cricket, which is very, everybody knows that it's impossible. Something like that. Even Reliance going in the same month 3,000 is impossible. It can go, but what are the chances? Maybe once in a decade or once in a 5-year once, that kind of movement can happen. It happened in Reliance. There are, I think when Jio announced some 3 months or 6 months from there, Reliance went up by same day, it went up by 11%, which is something crazy. This is back in when Jio got announced. But however, every week, if you look into that, Reliance movement will be like maximum 2 to 3, 5, 3 to 4 or 5% is what the actual movement is going to be. So you need, as I said, you need to have a probabilistic thinking. How much Reliance can move in this series, or how much Reliance can move in this week. If you are a short-term trader, you need to know how much a stock price can move. So that comes to a very, very important point called what? If you're an option trader, it doesn't matter whether you're option buyer or an option seller. It narrows down to only one thing: how much Reliance could move. Either upside or downside, doesn't matter. How much Reliance could move in this series or in this expiry series. So when I say series, I'll call this expiry. For example, we are in a June expiry. June expires at what? 30th June, right? 30th June 2022. June 2022. So we call it as a June series. It's a June series. June series started. June expiry is going on. That's the kind of talk what option traders will be having it. Right. So if I am buying June contract, then I should be right within this June expiry. If it is happening in July expiry, then you're not going to get benefit out of it. If you are buying a June contract, then your time is very less. So for example, let's say this is, I'll go to Nifty itself. I'll go back to Nifty. I'll reset the charts. I'll go back to Nifty. So Nifty, we know that it's trading around 15,293. Right. I'll go to options. I'll go and get 15,500 call option. Notice that 15,500 call option is at 173 rupees. Whereas if let me also record this. So Nifty 15,300 call option, 500 call option, 30th June expiry, which is like how many days to expiry? So that is called DTE. DTE is like 12 days. 12 days to expire. 12 days to expire. What is the premium? It's charged 173 rupees. 173 rupees has been charged. Whereas if I go to the maybe Nifty 15,500 call option only, but next week expiry, 23rd June expiry. Hardly we have another 4 days to expiry, right? Expire. So maybe since the time is very less, a lesser premium is also charged over here. Let's say I'll go back to the 23rd of June, 15,500. You can see that it's charged at 100 rupees. How much? 100 rupees. Same strike price, but premiums are charged lesser. Why? Because of the time. More the time we have, more the premium also charged, because probability is very high. We have more time now. For example, it is something like what is the chance that Virat Kohli can hit in a test match cricket compared to a T20? T20 hitting a 200 is way super rare, right? Nobody had done that. I'm not sure. I don't watch T20 cricket, but according to what are the knowledge I'm having, I can tell you, like, hitting a 200, a single man hitting a 200 in a T20 series or in an IPL series is very, 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 very high, close to impossible. Somebody could have done that in the future, but I'm sure so far none of them would have been done it in T20. But hitting a 200 in test match cricket is still possible, right? Already many batsmen had done that, hitting a 200 runs in a single test match, because we have more lengthier time. So possibilities of hitting a 200 is very high. Whereas T20, like a very short matches, hitting 200 is very close to impossible. Some people would have done 100, but 200 is closely impossible. Right, so something similar to that. More the time we have, more premium will be charged. Lesser the time we have, lesser premium will be charged. Or even if I even go to next month contract, see that I'll go to the next month contract. This is a monthly contract I'm taking, 28 July 2022. It's a monthly contract. You can see that it's charged for 367 rupees, because in this case, the time to expiry is very, very high. So maybe we have more than 1.5 months left for the July expiry. If I'm going to buy this July contract, then I have more time. Within that time, Nifty moving above is very, very high. So if higher the premium it is for an option buyer, the break even is also going to be higher. The break even also going to be higher. Let's say I buy this particular contract. If I am going to buy this contract, then the break even is also going to be very high. At least then means what? On an expiry, Nifty has to go and close at least above 1568. Then only the contract I'll be able to make money out of it. If I'm going to hold till expiry. If you're not going to hold till expiry, maybe today itself you're going to buy and tomorrow you're going to sell. Still, one can win. But still, what is the probability of winning? Here, mathematically, they arrive to a probability of winning here. 30% is a chance that if you are going to hold this position, listen carefully. If you are going to hold this position till expiry, this probability of profit is plotted for the expiry. If you're going to hold this position till expiry, the chances of one making money statistically and the price that the profitability itself can happen only above 15,868. That chances are 60%, 30%. For an option seller, it's the exact opposite. I'll do one thing. I'll change it to option selling. I'll reset this and then I'll change it to option selling. I'll change it to option selling, right? For an option seller, it's the exact opposite. 100 minus 30% is what we will get, like 30 point something. We get to like 69.18%. 100 minus whatever is the option buyer profitability is the option seller profitability. Why option seller probability is very high? It's very high because for an option seller, the break even is likely to be in their favor. For an option buyer, break even is against their favor. For an option seller, for example, this is call option selling. So call selling, in a call option selling, break even works in the favor of option seller. Why? Call option, you know that is a bullish position for a option buyer. Call option is a bullish view. A bullish view for an option buyer. Option buyer. Whereas for option seller is here, he is betting that Nifty will close anywhere below the break-even levels. That means what option seller is here, the bet is, it can be bearish or even it can be sideways also. How? Because the option seller is going to profit if the price is anywhere likely to end below 15,867 by expiry. Okay, that means even if the Nifty is going to stay at whatever the level right now here on expiry date, also he's going to get the maximum out of it, and his break-evens are very far away. 15,867. As long as Nifty is going to trade down below 15,867 levels, the profitability is guaranteed on expiry date. On the expiry date, anywhere Nifty is going to expire down below 15,867 levels, the profitability is guaranteed for the option seller, right? But how much money he can make? What are the premium he had collected? Maybe the premium would have been 18,000 rupees, 360 would have been collected, and that is the same money he could have got in his account also. I'll tell you how this transaction happens. First, you need to understand how this thing happens over here. So first thing first, I'll try to explain with a whiteboard. Let us say if I'm an option buyer, I'm buying an 15,300 contract, 15,300 call option. We know that every option buyer will be having an equal amount of option seller. Option seller, 15,300 call option, he's going to sell it. Let's say like it is going to be a monthly option. We'll take a monthly option. Okay, monthly option, and Nifty last traded prices will take approximately 15,300 is the last traded price. We'll go and get the premium value. I'll go to the tool Opstra. From here, I'll go and get the 15,300 monthly call option. Here is monthly option, monthly contract I'm selecting. 15,300 call option is what I'm selecting over here. 276 rupees is the premium. 276.8 is the premium. So that means what? 276 is the premium. Total premium is how much? Total premium is 276.8. Right, so 276.8. That works out to 276.8 into 50. 50 is the lot size. 50 is what? It's the lot size of Nifty. So that brings in terms of rupees, I have to pay how much? 13,840 rupees. 13,840, right? So 13,840. So 13,840. Oops. 13,840 rupees one have to pay as a premium. This money will be debited from his account, debited. In upfront, it will be debited upfront. And this money goes to the option seller's account via the exchange. Exchange will be sending this money to the option seller account. This money gets credited into the option seller account. So option seller will receive the premium. The premium rupees 13,840 rupees premium will get credited into the option seller account. When? Probably in T+1 next day. If I are selling today, next day morning you will be receiving this money into your trading account. Directly it will be credited. But since option seller are taking extraordinary risk, they also have to pay margin. They have to pay margin. Margin will be roughly very close to one lots of futures. Whatever margin charge for the futures, very close to that it will be, and depends upon what is the probability. Based upon that, exchange have a mathematical calculation for that. So, for example, the 15,300 call option, if you could see, the premium what we received is how much? The net credit is the total premium, whatever he is selling, that entire premium money will be getting into his account. Whereas if you see that the margin he have to pay, why he have to pay the margin? Margin is like a security deposit. Exchange will hold it. If in case there is any sudden accident is there, they will use the margin to settle the losses. The margin will be taken by the exchange to settle by the losses. Same day they will take it up. Upfront they will collect. The margin will be collected upfront. The margin, how much? Approximately 1 lakh rupees, right? 1 lakh rupees will be collected upfront. Means what? One thing you can learn from here, an option buyer need to have only 13,840 in his account to buy the option. Whereas if you want to be an insurance provider or an option seller, you have to pay a huge margin, a slightly higher margin. Because option sellers are theoretically having unlimited risk, not practically. Practically, yes, sometimes they do experience, as I said, but majority of the time, since time is in their favor, but still they have unlimited risk, exchange collects this margin like kind of a security deposit. Security deposit. Money will be returned back immediately if you're closing the contract. Anytime if you're closing the contract, the margin will be released from the system. Right? But the credit, you will be receiving the credit next day only. And as long as the credit is eroding, you have the rights to keep the money in your account. If the money option premium goes to 0, then you own the complete money from your account. It will be in your account and you hold that money. If the option premium goes to 0, that money will be still lying in your account only. That you become the owner of that money completely. All right, so let's move a little forward. Now, as I said, we have 3 different types of market participants. One is option buyer. They always buy the options. They pay only premiums. Whereas option seller, they have 2 components. They receive the premium in their account. That is why it's called as a credit strategy. And they pay margin for that as like a security deposit to the exchange. And then we have hedger. A hedger will be always having a combination of position. He'll be having an option buying position also. He'll be having an option selling position also. Simultaneously, he'll be having. So let's try to understand if I'm a hedger. There are 2 things I'm going to show you. If I am having a sideways view in the market, but still I'm an option seller. Let's say I'm an option seller. An option seller, not necessarily have to play only directional. He can play directional also. He can bet against option seller, option buyer. So if I am bearish, I'll do what? I will sell a call option. If I am bullish, I can sell a put option. Let's say this is only for the directional traders. If you're option seller, some option sellers, they don't go for direction, they go for neutral positions. Neutral means directionless. Irrespective of whatever the market direction, still they want to make money out of it. They are neutral in the market. They don't have any strong bullish view or strong bearish view. Maybe their expectation is like sideways markets. So what they will do is like they go and sell the call option and put option simultaneously. So they go and sell the, let's say 15,300 call option. They go and sell it and they pay the margin. And 15,300 put option also they will sell it. So they sell call option and put option on both the sides. So thereby they have to pay a margin over here. But the payoff graph looks like this. That means if the price is going to end anywhere between this range, then option selling is likely to be profitable. This is like approximately it gives a wide range. You can see the profitability of winning. Maximum profit is like 26,000 rupees they can make if Nifty itself going to expire around 15,300. Or they can construct strategies. They like, for example, they can go and sell OTM option, something like 15,800 call option, or a out of the money option, cheaper premium, 70 rupees premium. So by selling, they will collect 70 rupees, 50,000 15,800 call option, they will sell and they collect 70 rupees. And the downside also, let's say they go and sell 15,000 put option. Call option also they're selling, put option also they're selling out of the money. Maybe I'll go even more deeper, like 14,800 put option. They sell it like 104 rupees. They're going to sell on both the directions. So now they could be able to profit if Nifty is going to expire within this range. They can construct strategies, even if they're option sellers, they can increase the probability of success by selling the far away options on both the sides. And they get a very high probability of profit. And they look for return on the investments, like 9%. Maximum money what they can earn is within the next 12 trading sessions. If the price is likely to trade between this range, then this 9% of their money is going to be theirs. So I'll tell you what kind of option sellers will be coming into the markets. For example, the people who are, instead of parking in fixed deposit, you know that bank provides a fixed deposit of roughly around 4.5 to 5% is the fixed deposit right now, which is happening. So that is like 1 year. For a 1 year period, a bank will give an interest rate anywhere between 4 to 5%. Whereas if you are right in your decision, even if the market is going anywhere between 14,625 to 15,975, you have a higher chances of earning money, and that too a very high chance of earning the premium collected on both sides. You collecting by selling a call option, we collect the 70 rupees premium. By selling put options, we collect 104 rupees premium. So total we collect 8,785 rupees on both the sides put together. So if markets go sideways anywhere between this, then the trader will be at the maximum advantage. So traders make income out of it, right? So this is from the option seller perspective, but still risk is there. Suddenly market moving on the downside also, if accidents happening on the downside also, it will put the option seller at the risk. If the market suddenly moving crazily beyond an upper break-even, you see that there is an upper break-even and there is a lower break-even. So if the market is moving beyond that break-even levels, it could lead to serious losses on both the sides. But theoretically, unlimited losses, but practically price moving beyond these two levels are very, very less percentage. I would say like 70% of the time, markets are likely to trade within this range. Very rarely it can go beyond that range. So option sellers enjoy, most of the time option sellers will be at a greater advantage. Unless that crisis is striking, option sellers face that unlimited risk. Option selling is risky, but not all the time. But when that events are striking, it's going to be ultra risky for them. Like sometimes even option sellers, whatever the money they had earned in the last 6 months in one trade or two trades, they would have lost all their money because they are very much rigid about their view and they don't want to cut off their losses, and losses get extreme. Suddenly, at times it can happen, right? Because of the crisis, suddenly there could be a big gap down or a big gap up. It can happen. Because of that, option sellers can lose bigger money, right? But that risk is there for future traders also. Same risk is whatever the future traders are having big risk, at least compared to that, option selling has slightly lesser risk. But futures will have greater reward. Reward is unlimited in futures. Whereas in option selling, we have a limited reward, but chances of winning is very, very higher. That is the only thing that you need to know here. All right. Okay, cool. So there is some more few topics to talk before unwinding for the day. So here is the call option looks like. So price moves bullish. The trader is going to make money out of it. Limited losses. Whereas the payoff graph, the expiry day payoff graph for the option seller is exactly opposite to that. The premium money they collected is what the maximum profit. They have limited profits, unlimited risk only if it is going beyond the break-even levels. So an option seller, they have to be very much concerned about where is my break-even. The moment they are selling options, they need to know their break-even levels so that they can adjust their positions accordingly, or they can plan to exit their positions accordingly if something is going wrong against them. And as I said, time is going to be in their favor. Time is mostly in favor of option sellers. So what does that mean? That means only one thing here. That means they have a high win rate compared to option buyers. Okay. So you could see that most of the option buying strategies will be having like 50, 60, 70, even 80% of winning rate, even 90% of winning rate can be constructed from an option seller perspective. That's totally possible. You get to know what is your win rate, statistical win rate before you are punching your orders. That you can clearly look into that. Most of the option tools provide, like option tools like Opstra, they do provide such kind of things. So this is with call option payoff graph. Whereas for a put option payoff graph, the more the downside it goes, better the profitability is. Here also we have break even, right? So break even is like 15,043. Maximum profit is unlimited. It's not unlimited though, it's limited only because a stock price can maximum go down to zero only. It cannot go beyond that. But still, the maximum loss is limited to minus what are the premium money that one is charged. And the exact opposite is for the option sellers payoff graph, right? So, but still they have the highest probability of profit. Now, we learned that option pricing itself based upon intrinsic value and time value. So intrinsic value mostly depends upon which strike price you are selecting, what spot price you are selecting, what is the current spot price. Based on that, intrinsic value will be keep on changing. But time value is the anything other than intrinsic value in the money options. Only in the money options will have intrinsic value. We know that at the money options and in the money, at the money options and out of the money options will have only time value. The time value is decided upon two factors. One is how much days to expiry is there. We also seen an example where more the time we have expiry, more the premium is, lesser the time we have, lesser the expiry it is. And then how much volatility is there in the markets, which is something like more greed or more fear in the markets, more premium is charged. We already seen that. Whereas calm markets, no news, no events, no major happenings in the markets. Markets are relatively either slowly moving up or slowly coming down. Volatility in the markets will be very less. Expectations will be very less in the markets. When no fear or no greed is running in the markets, then option sellers will still demand lesser premium. For example, USD-INR currencies are not that volatile compared to stocks. So premiums will be very, very lesser in cheaper premiums will be there in case of USD-INR. You can go back and check it out. You can do all those analysis later because currencies are tightly controlled markets. So you don't expect even half a percentage move in majority of the days. Very few days it will go like 1%, and super rarely it can go to 2% movement. Whereas a stock can prone to move 5%, 10%, even 20% movement also we had seen. There are certain stocks, it went like 40, 60% also, some stocks. Like DHFL, one fine day I was seeing like it crashed 60% intraday, right? So such kind of crazy things happens in F&O markets. But currency markets are more stable compared to stock markets. Fluctuations will be very less, volatility will be very less, so lesser premium will be charged there. All right, so here is the option premium decay in time. Think about the time value alone. If I'm taking any time value, the time value alone, it erodes over a period of time. On the end of the day, when it is nearing the expiry, the time value will go to zero for all the options. Let it be in the money options. In the money options also have time value. Out of the money options also will have time value. At the money options will also have time value. In fact, at the money and out of the money will have only time value only. The time value will always go to zero. End of the day, end of the expiry, only intrinsic value only remains. But from this graph, what you can see here is, you can see that when start of the series, time value will slowly erode, but it will accelerate exponentially towards the expiry. And last couple of days, the premium erosions will be very, very higher. So means the option seller have more advantage near the expiry. As the expiry is nearing, let's say like last 4 days to expiry or last 2 days to expiry, option premium will crazily erode. And particularly weekly options will decay faster. The time value of weekly option will decay faster than the monthly options. So a lot of strategies can be constructed. There are many traders, they do passive income. They generate passive income out of this time decay concept. If you know how the time is, how this time decay is happening, so that we call it theta decay, right? Time decay is also called as a theta decay. One can construct strategies to make slow and steady consistent returns out of it. I mean, limited risk, limited reward kind of things. In a hedged way, there are many traders, they try to make a passive income out of it. And of course, open interest. Open interest is one of the major concepts that we need to discuss about it. Open interest shows how many contracts are right now open in a particular series. So here I'm showing for the 30th June, current monthly contract data point it is. You could see that there are more number of put contracts is lying at 15,500 put options. This is 15,500 put options. More number of people having more contracts still open at 15,500 options. Now, what does this mean? That means almost let's call this like 3.8 million. 3.8 million contracts. 3.8 million shares. I doubt it's number of contracts, it's number of shares. If you divide by 50, you will get number of contracts. You get number of contracts. Because 50 is the share of Nifty, right? Number of contracts is not controls, it's more of contracts. More of contracts. So what does this means is like there are 15,500 put options, traders are more. That means 15,500 put option, more people are expecting that Nifty will go down. That means what the put buyers are expecting. In this July series, this is the June series. So in June series, more put buyers at 15,500 are expecting a market crash. Expecting a market crash. But we know that for every put buyer, we also have a put seller also. So 15,500 put sellers are more because more number of put sellers are expecting this series Nifty would not crash below 15,500. Now, in reality, we don't know who is going to be right, but I can tell you only one thing. Who has more winning odds? 15,500 put sellers have more winning odds. Very rarely, yes, put buyers can win statistically because I say very rare because the winning odds are very, very less for them. Whereas for an statistically speaking, 15,500 put options going down below them are very rare, but it can happen. I'm not saying it cannot happen at all, but statistical probabilities are very less. That is why maybe 15,500 put options are crowded by more option sellers. Of course, more option buyers are also there. Equal amount of option buyers are also there. So they have exactly same opposite thinking. But the only thing is like the time is always in the favor of option sellers. But let's see once in a while. But if there's going to be any more panic, if the market crashes, definitely put option sellers are going to lose a heavy money over there. All right. So by looking into the open interest, earlier we had only monthly open interest some long time back. I think 2017 is where 2016 is where the Bank Nifty weekly option started. Prior to 2016, we had only monthly contracts. So back then we can use those open interest as a support level or resistance level. Now, last 6 months, the way Nifty is happening, I would say like it's very difficult to interpret open interest as a support or resistance zones. Maybe in a calm bull markets, maybe we could be able to anticipate the highest put options levels as a kind of very close to support level or resistance level. But in this kind of bear markets, there are no respect. Those levels are keep on breaching downs. So you cannot really treat open interest, particularly weekly options open interest levels. Let it be call option open interest level or a put options open interest level. We cannot use currently those open interest levels as a support or resistance, even though majority of the traders they do. But if you are a beginner out there and you should at least to stay away from open interest, you can consume the knowledge. Open interest is more of a knowledge. You cannot use open interest as a signal to enter or exit. Many people they do that, but I can tell you that maybe 1 or 2 times they're going to win by looking into open interest. Majority of the time, open interest gives more damage than gives a meaningful signal out of it. Right. So trying to interpret the open interest is like blind man trying to touch the elephant and trying to interpret what exactly it is. Right. So it's something similar to that. But I can tell you very boldly, looking into open interest, mostly it is waste of time. Very few places you're going to get signals, that to a few environments. So I do look into open interest, but I don't think too much into the open interest. Okay, very few places I give more importance to open interest, but majority of the time, open interest is yet another information about the markets. It's one more additional information about the markets, where the put option traders are crowded, where the call option traders are getting crowded. That is more of an information, and these information could change, particularly in a weekly option. These open interest details are likely to change. Maybe I'll show you how the open interest of the weekly information looks like currently, right? So, I mean, I've been trading this market for more than a decade now, so I can boldly tell you that I've seen all kinds of open interest details in the last couple of years. Only we can cook stories on open interest, how the market had went up like this, how the market had went up like that. Yes, some places definitely open interest had proved as an kind of support or resistance, but these kind of last 6 months kind of markets, open interest has been keep failing repeatedly again and again and again. So I do look into open interest not in real time. Some people they do interpret live open interest also, but that is not true values. Open interest only on closing of the market hours after 3:30, it will show the live exact open interest. Right. So I don't take open interest very seriously, to be very frank. Some people they go by the theoretical concepts, but I would say like one should avoid, even if you're a beginner, it's all these are good to know concepts. But live trading, when it comes to live trading, one should stay away as much as away from the open interest. So this is weekly open interest. Right now you can see like a lot of green bars are there. That means a lot of call option sellers are the one who is making money over here. So more people are expecting markets to go up, but markets are not going up. Market keeps on sliding down. So when the market keeps on sliding down fiercely, more and more aggressive option sellers are coming and selling on the call side. And the call buyers are also, they're trying to speculate, but the thing is not happening for the option buyers, call option buyers, nothing is happening so far. All right, that is one more important thing. When it comes to Indian markets, there are always two kinds of options are there, European options and the American options. Till 2010, right? So all the index options like Nifty options and Bank Nifty options, it belongs to index options, were European options. And all the stock options are American options. This is back in 2010. But after 2010, all the options now becomes European options, which is best. If you ask me, European options are best because European options can be exercised only at the expiration date. So you might be asking, what is exercise? Means you can, if you're having an options, you can convert into shares. If you're having an in the money options, you can anytime you can ask them to settle. You can call the opposite party to come and settle the shares. But European options are you can exercise only on the expiry date only. You can convert into physical shares. If you're having a stock options, you can convert into, you can buy, you can settle it in terms of stocks. You can buy the stocks, or you have to give delivery to the stocks on the expiry date only. So only on expiry date, the settlement happens. Whereas in American options, which is what we used back in 2010, can be exercised at any time on or before the expiry date. If I am an option buyer, I'm demanding option seller to settle the shares. Option seller have to, the same day, they have to come and settle the shares. Not necessarily have to wait for the expiry date. But luckily, we are in European option. We are not in American option here. So when it comes to physical delivery, right? When it comes to stock options, only in the money options are settled for a physical delivery. Not that the money options and out of money options, because they go worthless, expiry, it goes to zero value. So for those, there is no compulsory physical delivery. But for in the money options, if you are having a long call and it is expiring with an in the money option, or if you are having a short put and that too is an in the money option, you have to take compulsory delivery. If you are not closing the contract, remember, if you are not closing the contract, you have to take a compulsory delivery. Or if you are holding a long put option and becomes in the money, if you are closing the contract, you don't need to give any delivery, right? But if you are holding the stock, you are allowing to expire in the money, you are not closing the position, then you have to give delivery. That means you need to have, physically, you need to have the shares in your demat account, so that you are allowing to expire, and so you are willing to give delivery on the same date. So people will be purchasing the stock from your account. The opposite party will come and purchase the stock. So you have to give the delivery to them. Right. So one of the reason, if in case you are only involved in stock options, then you should aware that last day of the trading day, on the expiry day, if your position is getting in the money, try to square off your position as much as possible. Otherwise, generally broker will call you and then you will square it off. If the brokers are not calling and you are allowing the position to expire, you have to give a delivery. And if you don't have stocks, you are supposed to take delivery, or you're supposed to give delivery, and you are not noticing your options ending in the money, and you are just like that leaving casually, people ended up paying huge penalties. Right? Penalty, because you have to give delivery. If you don't have stocks, it will go for auction. So next day morning, it will go for an auction, and whatever the rate the buyer or seller is demanding, they have to go and pay it, and that will lead to a huge serious losses. For many traders had suffered a huge serious losses. And some manipulation also happened in some of the stock, like Hindustan Unilever, some stock ended in the money, and the guy is not able to find an opposite party. Nobody came for closing the contract, so his contract ended in the money. It was a cheap option, but it ended in the money because price went in his favor. So it becomes in the out of money, stock went in the money. So he made profit in the money options, but he had to give a compulsory delivery. He was holding huge lots, like something like 11,000 shares or something like that he is having. So he had to take a compulsory delivery. He don't have the money to pay. So he ended up, the stock went for an auction and he had to pay a very heavy fine for that. So if you're an option seller, for Nifty and Bank Nifty, our currency are mostly settled in cash. Even in crude oil also, crude oil futures, crude oil options also settled in cash. But something like gold we have to take a compulsory delivery. Stock options, we have to take a compulsory delivery. So you should not allow the position to carry. It's better not to trade on stock options on expiry day. Maybe next month contract one can trade, or next week contract one can trade in that case. Right? So that is the one thing an option buyer or even option seller also have to understand this. If you are holding stocks and if you purposefully or you wantedly knowing that you are what you are doing and that satisfies your purpose, then it's okay to allow the position to expire in the money. So anyways, you are planning to take delivery or you're planning to give delivery of the shares. In that case, it truly makes sense to allow the stock to expire in the money. Else, anyway, you're going to allow it to expire in the money, totally, it might lead to a disaster, even if you're an option buyer or even if you're an option seller also, for that sake. All right, so some important notes over here. These are most important notes. I would say like time decay. You know that option premium decays in time. On a daily basis, it decays in time. Even on Saturday, Sundays also. On the pre-anticipation of Saturday, Sunday, or even holidays, the option premium will be eroded a bit faster. Even though markets are not there, even before the market holidays, the premium will erode. Ahead of the holiday or ahead of Saturday, Sunday, the premium will start eroding a bit faster around that levels. And we know that option premium is mostly affected by volatility. When there is too much of fear or too much of greed is there in the markets, means markets will be too volatile, then more premium will be charged. Lesser premium in a calm markets. An expiry day. So near to the expiry day, premiums are cheaper and rate of time decay is very, very high. We also learned that on the expiry day, exactly the time value will go to zero. And one final thing, it's a compulsory delivery. If you are going to carry forward in the money options, stock will go for compulsory delivery. Either you have to take compulsory delivery or you have to give compulsory delivery. Depends upon whatever the scenario it is. Right? So I guess if you have any questions, I can answer your questions. Otherwise, more or less, we are at the end of the session here. It's a 3-part series. Definitely, the next 2 weeks, we are having, I think we have another 2 more very interesting sessions are coming up, lined up. Let me take a couple of questions here. So there is, Lakshman is asking, do we get the recording of the session? Absolutely, we'll be getting the recording of the session. Right? I think another 2 hours from here, the recording should be completed and you should be able to view the recording. B.V. Krishnamurthy is having a question. His question is, would not crash above for PE sellers. So for a PE seller, if somebody is a put option seller is what? Put option buying is bearish view. So put option selling is a bullish view. So if the market is going above, if the markets are keep on going above, put option sellers will make money, right? Or if the put option seller is what? They are betting that market will not fall. So only if the fall is happening, then only they will be at a maximum disadvantage. On expiry day, many times high volatility is noticed. See, that is a phase. Different times market does differently. Back in 2016, 17, 18, 19, expiry day means no volatility. But of late, after 2020, after coronavirus crisis, something has been changed in the market. I don't know what got changed. Every expiry is a highly volatile expiry, particularly in the last October 2021 onwards. It is a phase. It is a phase that option buyers are getting benefited more on the expiry day. Every expiry, almost most of the expiries are blockbuster expiries. No, but not every expiries. Most of the expiries these days are blockbuster expiries. Earlier, 2016, 17, 18, 19, those phases, only very few expiries are blockbuster. Out of 100 expiries, maybe 2 or 3 expiries are blockbuster expiries. But now out of 100 expiries, maybe 20 expiries are blockbuster expiries. Means something has been changed in the market. The change is what something will be constantly keep on happening in the markets. We never know when this scenario will change, but it will change because most of the time market favors option sellers. But we are living in a phase where right now, this period is favoring option buyers. Is it true that it will be always every expiry will be volatile? Definitely not. Sometimes the market will move towards calmness, certainty. Right now, we are having a lot of uncertainty. People are talking about Ukraine Russian, that could evolve into a world war. Crude oil is spiking high, right? So interest rates are going up, inflation is going up. So a lot of uncertainties are there. When these uncertainties are settling down, maybe option buyers will be at the greater disadvantage on the expiry dates. Maybe market might be calm. Expiry days will not give more money to the option buyers. That was historically true. In the past, options buyers very rarely made money. But now option buyers are making money on the expiry days. Left, right, they are making money. And that is a phase. Because probability means even if it is 80% probability means there is a 20% chance that option buyers can still make money. Probably that 20% is now happening. But once again, that fear, right? Fear could subside at some point in time, and a rational sense prevails in the markets. When rational sense are prevailing in the markets, maybe option buyers may not be able to make money. As long as markets are behaving irrational, option buyers tend to make money. When the markets return to rationality, generally option buyers, time is not going to favor for them. So they have to have strong skill if in case they want to make money, right? For an option seller, time is a friend. For option buyer, their directional skills are their friends. So one have to be very strong with their directional skill. So Jay Chandra is asking about any other pros, cons of option selling. Yes, there is a biggest drawback, biggest disadvantage for the option sellers. Option sellers, they taste the success. They're going to taste the success most of their time, right? But the most important con is the disadvantage, like when things are not working against them, not willing to give up their positions or not willing to give up their view, could put their strategy at a greater disadvantage, because that is the only place they're going to take unlimited risk. Of course, margin is another disadvantage. Margin can be overcome by having some hedges. Exchange will give something called margin benefit. If somebody is willing to control their losses, that can be controlled if they're going to hedge their positions. Maybe we'll try to look into that very detail in the next part, how one can get a margin benefit, how an option seller can get a margin benefit. Even option buyer also, if they want to hedge, they can hedge it. Maybe we'll discuss all those things in our upcoming sessions, right? So that how the option benefit or how the margin benefit will be transferred to the option seller, or how option buyer can hedge their positions, or how an option seller can hedge their positions. Now, those things that we'll be discussing in our next upcoming chapters. So Kamala Kannan is asking, kindly provide your inputs about current market by using market profile. Anyways, today we are not going to discuss about market profile. Even our upcoming program, we have an upcoming program on option Hydra. If you go to webinars, you can go and see our upcoming mentorship program. From this option Hydra 5.0 onwards, it is kind of a mentoring program for option traders. So this time we're going to introduce a new concepts called volume price analysis or volume spread analysis, VSA, and a couple of our known price action. It's not the same price action like the rally-based rally or drop-based drop. The price action based upon my last 14 years of trading, how I had seen the price action, where price action would have given without using any indicators, how price alone can provide trading opportunities. Some of the price action techniques that I'll be explaining over here. In this, it's kind of a option Hydra is kind of a mentoring program for the option traders who are really serious about options trading, and they want to take advantage of the price action and the volume spread analysis. Using that, how we can build a framework for a slow and steady option trading career in the long run. That is what option Hydra is all about. So you'll be learning a framework, how to use it. We'll be using volume spread analysis and price action for analyzing the markets, and options for controlling our risk and to maximize our profitability. All right, so you can go back and check it out. It will be available under webinar section. And any new webinars coming in under webinars, you'll be able to see it under the upcoming webinar section. Any free webinars generally we'll be doing around every Saturday. Right, this time we are doing slightly extended session. Generally we'll be doing like 1 hour session. This time we thought like we'll try to do an mini certification on options trading, so that all the basic concepts we'll try to give it at free of cost, so that one can get the basic knowledge of options totally without spending any fee. Right, so we'll try to give some right knowledge on that. That is what we thought about it. Anyways, so this series that we are planning for 3 parts. Already 1 part is already done. Remaining, we have 2 more parts. We are starting from 25th June and 2nd July. We'll be completing most of the basics of option basics. So if you are a beginner out there, or if your friends are beginners and you love this session, definitely if you gain some knowledge about the session, please pass it on to your friends so that they can get benefit out of this. Right. So next week, what we're going to talk about is like we're going to talk about a top-down analysis approach to the markets, how to take a top-down analysis, and how to understand the market structure, how to get a trading perspective, and the importance of measuring the volatility. So why we should measure volatility, and what is implied volatility, what is realized volatility, an introduction to volatility skew, how I can measure the volatility skew, and how to retrieve historical options open interest data from the portal, and importance of reading India VIX, what we can infer from the India VIX. And more interesting concepts about volatility and volatility-based strategies is what we want to discuss in the part 2. Very important one. Even if you're an option buyer also, you should attend this. Even if you're an option seller also. If you're an option seller, you should definitely must attend this session. All right. So see you next week. And thank you for your time and coming and spending your wonderful time along with us. Have a great day. Thank you.